Today, I'm going to talk about the stock market strategy for 2019. I'm going to give you a couple of points to think about to get you ready for 2019. And of course, I'm going to give you a trading strategy at the very end, something a little different, something to help give you some opportunities for 2019. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner with Sickle Hunter Financial Advisors. Okay, let's face it, 2018 has been a challenge. The stock market did really well, and then it just went down, and right now it's not doing that great, but that is the price. We want to look at something a little differently, and I'll put you in the right frame of mind. So let's start at this bullet points that I have up here, and then I'll get to that trading strategy at the very end. So number one, reevaluating your positions. So how do you do that? So we're seeing all the prices go down right now. Most of the things in the market are down. So what you want to do is go back to the annual reports. You have to look at what the value of the company is at, not the price, but the value. So go back and do your homework, do your research, and say to yourself, what is this worth? Did the value of the company actually decrease? Or is it just a short-term price decrease? They're two different things. And really what we want is something that's on a discount. So if there is a discount on a current stock, that could be a good thing. So reevaluate it. Go back to the annual reports, do your homework, go back to square one. Remember, price is what you pay, value is what you get. Okay, number two, let's reevaluate your saving strategy. It's very common sense. This is common sense. This is common sense right now. Okay, let's take a step back. We want to look at our saving strategy. What happens when things go on discount? You buy more of them, right? Black Friday deals, you buy more. You line up at the store. Some people are camping out for this stuff. You should be too, especially if you've done your homework. It's always going to circle back to number one, which is doing your homework, looking at the position, figuring out what that value is, and then making a decision based on the price. So if the value is here, right, and the price is here, that means it's a buy. So go back and look at your saving strategies. When the market goes down, people notoriously stop putting money into their retirement plans, stop saving, and that is the complete opposite of what you should be doing. Right now is when you should cut back on those expensive lattes, eating out, because at that point you should be so excited that the stock market is going on sale. Go back, do your homework. Think about it. What would you do before Black Friday? You're doing your homework on where the best deals are going to be. You're figuring out where you're going to spend your time, what stores you're going to visit, where you're going to camp out, what deals are you going to get? Because you're saying, well, I'm getting 20, 30, 40, 50% off. I might buy 2, 3, or 4. So as these prices are decreasing, just like as in Black Friday, you see the prices going on discount for 20, 30, 40, 50% off. You think it's a great deal. The stock market's the same way. You know what the value is because why? You should be doing your homework. That's number one. So number two points right back to number one. Do your homework, figure out what you're investing in before you invest. And then once you do it, reevaluate it. Now, if the value changes, that's okay to change your mind, but you're really doing yourself a disservice, causing financial harm to yourself when you're making decisions based on emotion and not facts. All right, number three. Let's take a look at number three. That's our shopping list. Reevaluate your shopping list. When you see a deal in Black Friday, what do? You reevaluate your budget and you see if you can afford it. And you might take something from somewhere else to go out and do that because you think it's a better deal. The stock market's the same way. You should have your buy list. If you don't, it's a great time to create one. Or find the stocks that you think that are well-run companies and wait for those prices to take a hit based on something that's not relevant to that particular company. For instance, the entire stock market. A lot of times when the whole market goes down, everything goes down, including the good stuff. So even when you find a good stock that you want to buy, but the price is a little too high. You just have to show a little bit of patience. It points to number one as well. That shopping list, it points to number one as well, because you have to go and do your homework. If you're not willing to do your homework, you can't go shopping because you don't know what you're buying. And if you don't know what you're buying, there's no sense in doing anything, because the whole objective is to make money. The stocks that you want to add to your shopping list are the ones that are underappreciated. Maybe they're not underappreciated enough, so that's why they're on your shopping list and not necessarily your buy list. So just think about that. Have a buy list, have a plan, and go back and do your homework. Notice everything always points back to doing your homework. That's what you need to do. It's actually a lot rarer to have a market such as this right now, where the prices have gone down significantly in a short period of time versus when the market's doing well. There's these quick declines in the market. And we can't predict them. We don't always know when they're gonna come, but when they do, they're quick. Now, the recovery could be quick or could be slow. We don't know, but it's a great time to, again, build your shopping list, go back, increase your savings, go back and do your homework. Okay, so now you want a little different strategy for when you have a down market, you have an opportunity. So let's go ahead and dig into a trading strategy that may or may not work for your situation, but I'm gonna share it with you, and if it works, great. Okay, so let's take a look at a stock market strategy that might work for you. So here's how it goes. I'm gonna throw it up on the board first. Okay, so this is a deep in the money call option. Now, what the heck is that? It's a little complicated, but I'm gonna walk you through it and help you understand. So if it's right for you, you can take a look at a deep in the money call option. Now, I am gonna use a real world example. This is not a recommendation. I'm not telling you to go out and buy this call option. I'm just showing you the strategy. So if you have a position that you really like, you can look at some options on it to see if it makes sense. But you're gonna have to do your own work. You're gonna have to do your own research. So again, this is just for illustrative purposes. I'm going to look at an Aapl call option. So if we look at and I have it written down here, we have the January 15th, 2021 call options at $145. I'm gonna write that up on the board. If you don't know what I'm talking about, I'm gonna break it down for you. This is what we're looking at. So the strike price is at $145. Okay, so let me give you a quick primer on call options. So if we buy this call option, what we're saying is that if Aapl is trading at $145 or greater, okay, 145 is our strike price, 145 or greater, that's called in the money. That means we're making money. Not totally, not entirely, I'm gonna explain, but just stick with me. So right now, Aapl is right about $165, bouncing between 165 and 170. So it is higher than 145. So this would be a deep in the money because it's already above. The current price is above 145. So what this means is, ignoring this date for a second, if we just look at the 145, if today was the strike price, and let's call it 165 from 145, so the current price is at 165 and the strike price is at 145. And if this date were today, then we would make $20 per call option multiplied by 100, okay? Why? Because all options are quoted in lots of 100. So you're controlling 100 shares. What this means is this is gonna have a price attached to it. What would you buy this option for, okay? So we just looked at it, it was $40.25. So if that's the case, that means you'd pay $40.25 to buy this option. This call option was selling for $40.25, or that was the last price that we just saw. So this is multiplied by 100. So in reality, that's multiplied by 100. So the price of this option to control 100 shares of Aapl is $4,025, okay? So let's go back to here. Obviously, if you're paying this amount of money, $40.25, and there's only $20 here, you would have lost money. But let's say for a second, we take a step back. Today's the call option. This date is today. And let's say this was selling for $5 instead. Then $5 would be tacked on to this price, because this is our strike price. So 150 would be your break even. So if 150 was our break even, and it's at 165, you could see that you've made $15. Again, multiply that out by how much? 100, and that's how much money you've made. Now, why did I choose this call option? It's so far out. This is the farthest call option that we can currently buy for Aapl. The reason being is the bet here would say that we believe that this price plus this premium that we're paying for it, this $40.25 that we're paying to get this strike price. So we add those two up. So the only way we'd make money on this option is if the current share price, which is currently at 165, is going to be higher than 185.25 cents. That's what we're saying. So as long as it's higher on this date. So in the next 2 years, will Aapl be trading higher than $185.25? And if that's the case, then we've made money. Why wouldn't we go out and buy? So the question that you might be thinking is why 145? Why not get something that's at 165? And when you look at the prices, they're going to be cheaper the higher you go. So when we're looking at that, a 145 call option in the future at any time is going to be more expensive than something with a higher price point or a higher strike price into the future. So if it's at 170 or 180, it would be less than $40.25, or at least it should be. And if the reason we're buying something that's so far in the money is because if we fast forward and let's say that share price is at 150 or 160 or 170 and we haven't made our money back, we can actually change that and go out and buy that position. So if as long as it's above 145 and it's above that strike price, we can immediately buy those shares at this price, even though we've paid more money for it. We still have to pay $145 for the share times 100, but at least we get that opportunity that if the market at that point is still down, or if it hits another bump in the road and it's somewhere below that 185.25, then we can then own the position and hold it for as long as we want. So if we do think that it's going to recover right after that, then we can recover our money. Yes, this strategy is more risky. However, this is called leverage. So we're controlling 100 shares. So what does that mean? So we've paid $4,025 in order to have this call option into the future. Now, if we wanted to go out and buy 100 shares at $165, so if we do that, that would be $16,500. So rather than putting out $16,500, we only put out $4,025. So we're using a smaller amount of money to control a larger amount of shares. That's the big difference. Now, using options in general is going to be way riskier than just going out and buying the underlying security or just buying the stock. So you have to understand that from the beginning. And not every stock has options on them. Now, you can simply look at options looking at something like Yahoo Finance, and they'll show you the options chains, or Bloomberg, or any of them. They'll all show you where the options are, and you can look through them. Now, they look super complicated, but once you start to understand how they work and how to use them, then it could be a part of your investing strategy. But again, this is riskier than just owning the individual stock. Why is that? Because there is no leverage involved. So you're not expected to or need to have that $16,500. If you already have that money, you put it into the stock. If it goes up, you've made money. If it goes down, you've lost money, but there is no recourse to that. By using options, you're actually adding a second parameter, which is really making your life a little bit more difficult, and that's time. When you own a stock, you can own it for as short or as long as you'd like. But when it comes to an option, it has a set date on it. So you have to not only get the value right, but the timing right as well. So there's an added layer of inherent risk and uncertainty, which creates that risk and creates also that opportunity or that potential opportunity in order to make a little bit more money. Now, the current environment makes this a little bit more attractive in general for other stocks in general, not specifically Aapl. But if you're looking for a different strategy, something that you can use to begin 2019, or something that is in a down market or a down position, this could be the right strategy for you. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.